Welcome back. I'm John A.G. All right, today we are not doing a hype show. We are not doing a doom show. This is a pressure show. The pipes, the leverage, the warehouse tags, the delivery promises, and the metal that keeps returning every time the system looks nervous. Silver. Because the loudest claim in the market right now is simple. Silver is the fuse. Silver breaks first. Gold follows. Derivatives shake. Banks panic. Markets freeze. And within days, the world discovers that paper promises were never the same thing as metal in hand. That is a powerful story. It is also a dangerous story if you repeat it without separating verified stress from theatrical collapse. Before we go deeper, a small complaint from my side. My YouTube stats show many of you watch these videos but still have not subscribed. So support the work, subscribe to the channel, and comment OG John AG if you actually value this content. Now let's get straight to it. Is silver tight? Yes. Is silver volatile? Absolutely. Is there proof that a delivery failure is already scheduled? No. That distinction is everything. The real market is built on inventory, financing, open interest, registered metal, eligible metal, delivery notices, and whether someone with bars will let them leave the system. So when somebody says, silver is about to expose a $2 quadrillion derivative bomb, the first question is not, how high can silver go? The first question is, what number are you using, and what does that number actually mean? Because the Bank for International Settlements reported global OTC derivatives notional at $846 trillion at end June 2025, not a confirmed $2 quadrillion. And even that $846 trillion is not the same as real loss exposure. Gross market value was reported at $21.8 trillion, which is still enormous, but it is not the same category as notional value. That does not make the system safe. It makes the argument cleaner. The threat is not that every derivative explodes at once. The threat is that a small, stressed, physical market can force the paper market to answer one ugly question. If enough people ask for delivery, who actually has the metal? And that is where silver becomes interesting. Gold is money in the minds of central banks, funds, and long-term wealth holders. Silver is different. Silver has a monetary side, but it also has a heavy industrial side. It goes into electronics, solar, medicine, electrical systems, and advanced manufacturing. You cannot put a paper contract into a circuit. You cannot solder with a spreadsheet. You cannot build a panel with a promise. But here's the twist. The industrial side is not moving in a straight line. The Silver Institute's 2026 outlook says industrial silver fabrication is expected to decline by about 2% to around 650 million ounces, partly because solar manufacturers keep reducing silver use per unit and searching for substitutes. At the same time, physical investment is forecast to rise 20% to 227 million ounces. So this is not industry alone swallowing the market. It is a mixed story. Huge industrial demand, rising investment demand, violent prices, and another expected deficit year. Now let's talk about the phrase everyone loves, failure to deliver. A real delivery problem is not the same as a scary post or open interest being bigger than inventory. Open interest is always larger than the metal that actually moves because most futures positions are closed, rolled, hedged, or offset before delivery. The question is not whether every contract could demand bars tomorrow. The question is how many actually stand, who is short, who can source metal, and whether metal must leave the vault instead of just being retagged. That word matters, retagged. A lot of delivery activity can simply be ownership changing while the bar stays in the same vault. One party gives up the warrant, another receives it. The bar does not roll out on a truck. The label changes. Stress begins when retagging is not enough, and trucks, ships, refineries, banks, and end users enter the same narrow hallway. COMEX publishes delivery notices and warehouse stock information, and CME says silver futures and options are risk management tools connected to physical delivery processes. Stress can still happen, but calling the entire future system proven fraud without delivery evidence is too easy and too sloppy. Now, have there been real manipulation cases in precious metals? Yes. The CFTC ordered JP Morgan to pay $920.2 million in 2020 over spoofing and manipulation across precious metals and treasury markets. That is documented. But one proven case does not prove every short today is naked, criminal, or designed to suppress silver forever. This is where serious people must slow down. A short position can be manipulation. A short position can also be a hedge. A refinery hedges. A dealer hedges. A bank hedges client exposure. A miner may hedge future production. If you see short and instantly scream crime, you miss the structure. And in silver, structure is the whole game. The real question, are shorts forced to deliver metal they cannot obtain, or managing exposure against inventory, financing, and client flows? If the answer is the first one, then yes, the market has a serious problem. If the answer is the second one, then the panic story weakens. This is why the next chapter is not about price predictions. It is about proof. Show me registered inventory, delivery notices, exchange for physical pressure, lease rates, physical premiums, and whether metal leaves the exchange or just changes hands inside it. Without that, a collapse timeline is just theater. Now, let's talk about Asia, because this part matters. The broad story says North America is selling and Asia is buying. There is truth inside that, but it needs precision. High prices can pull retail silver out of weak hands in North America, especially if households need cash. At the same time, India and China have deep physical metal cultures, and many buyers there want metal, not a nice contract with a logo. But do not overstate it. Not every Asian buyer is draining vaults. Not every American seller is desperate. Not every bar leaving one region means the global system is breaking. Flow is not the same as failure. Still, the direction is important. If physical buyers keep demanding metal and paper sellers assume cash settlement is always enough, eventually the market must choose which side sets price. That is the cliffhanger in silver. Not tomorrow at 9:30, not within some magical 72-hour countdown. The real cliffhanger is whether price discovery stays inside futures screens or migrates toward physical negotiation. If you actually made money in this metals move or protected savings through discipline, share that in the comments. People need to see real examples, not just fear. Because the goal is not panic, the goal is preparation. Now let's test the extreme scenario. Could an exchange take emergency action in a crisis? Yes. CME rule materials allow emergency steps such as suspending, curtailing, or terminating trading, demanding additional performance bond, changing limits, or taking other actions to protect orderly markets. But possible is not the same as imminent. That is where many viral scripts go too far. They take a rulebook possibility and present it like tomorrow's headline. They take a deficit and call it default. That may get clicks, but it destroys analysis. And remember, the market does not care about our preferred narrative. It cares about settlement. It cares about financing. It cares about who can deliver, who must borrow, who must roll, and who must pay up. That is why the quiet data often matters more than the loud prediction, especially when everyone is emotionally locked on one dramatic outcome at the worst possible moment today. Silver can rise sharply without the world ending. It can correct violently while long-term tightness remains. It can have real pressure and still avoid formal delivery failure. And that is why this market is so dangerous for emotional investors. The people who chase late hear $500 silver and think it means easy money. But if silver ever moved that violently, ask yourself what else would be happening. Would credit markets be calm? Would banks be relaxed? Would industrial users be celebrating? Would governments sit quietly while a strategic metal turned into a monetary alarm bell? Probably not. So yes, be careful what you wish for. A silver spike could protect wealth, but it could also signal damage elsewhere. The win on one screen might come with stress in your job, your business, your currency, your supply chain, or your banking system. That is why physical metal is not just an investment idea. For many people, it is insurance. You do not buy insurance because you want the fire. You buy it because fires happen. But do not confuse insurance with obsession. If you are new, do not rush in because a stranger shouted, "Last chance." Think in layers. Cash first, debt discipline, emergency reserves, then metals, then miners, if you understand equity risk, then speculation, if you can be wrong. Now where does gold fit? Gold is not under the same industrial pressure as silver. Gold is the confidence barometer. Central banks, institutions, and private investors look at gold when trust falls. The World Gold Council said total gold demand in 2025, including OTC, exceeded 5,000 tons for the first time, while central bank buying remained durable through the year. That matters because silver may be the stress point, but gold is the trust point. If silver breaks confidence in paper metal, gold does not need the same shortage to move. Gold only needs people to ask one question: what else do I trust less than I trusted yesterday? That is how contagion really works, not Hollywood explosions, confidence migration. First, people question paper silver, then paper gold, then the currency used to settle, then the institution behind the currency. It does not need 72 hours. It can happen slowly, then suddenly. And now we arrive at the cash and carry idea. A cash market does not mean civilization ends. Milk can trade without milk futures. Eggs can trade without egg futures. A physical silver market could keep functioning even if futures credibility weakened. Buyers would bid. Sellers would ask. Real metal would set the terms. But a cash-dominated silver market would feel different. Liquidity would be lower. Spreads, premiums, relationships, and location would matter more. A bar in the right vault would not be the same as a bar promised from the wrong place at the wrong time. That is why the paper versus physical debate refuses to die. Paper gives speed, physical gives finality. Paper gives liquidity, physical removes counterparty. Paper gives price discovery, physical gives settlement. In calm markets, paper dominates. In trust crises, physical starts speaking louder. So the question for viewers is simple. Do you think silver is still a futures-led market, or has physical demand already started taking control? Comment your answer, because this is the debate that decides everything. And one more thing. If you are one of the people here who built a business, bought metal early, avoided leverage, or survived a tough financial period because you stayed disciplined, share that story. It raises morale for others trying to make better decisions. Now let's get to the bottom line. The clean version is this. Silver is tight, volatile, and structurally important. The deficit story is real. Physical demand matters. Investment demand is coming back. Derivatives can amplify stress. If delivery confidence cracks, markets will not treat it like a normal headline. But the viral version, saying the system definitely fails in 72 hours, banks definitely close, and every futures contract is already fraud, that version is not confirmed. Do not trade confirmed data with unconfirmed drama. Watch the real signals. Registered inventory, actual deliveries, physical premiums, lease rates, ETF flows, industrial demand, recycling, regional spreads, and exchange rule changes. If those signals tighten together, then silver is not just moving, it is warning. And if they do not tighten together, then the market may still be bullish, but not broken. That is the difference between being early and being reckless. So no, I am not here to tell you silver is nothing. Silver may be one of the most important pressure points in finance right now, but I am also not here to sell you a countdown clock. The real story is more uncomfortable. Silver does not need a fake apocalypse to matter. It already matters because it sits between industry, investment, leverage, and trust. It is small enough to move violently, useful enough to be demanded physically, and emotional enough to attract the loudest narratives in finance. That combination is exactly why we watch it. Not because every rumor is true, because the real data is already serious enough.